how to make $100,000 per year with prop firms using hedging strategy. That's 8,300 per month. We're going to have a look to this in this video. Also check the main prop firm we are working with that makes about $250 million revenues per year, which is FTMO, as you might know, the leader in the industry. We're also going to dive in all the details for the process to go step by step to the 100K per year, about 8,300 per month. So we're going to look to this. First off, let's just remind you, I'm Roman Quater. You might have heard of me on Upwork, where I have more than $50,000 total earnings. I specialize on FTMO, challenge passing, and management on funded stage. So we are going to dive in the spreadsheet that you can see here on the screen. So nothing to be scared of. It's pretty straightforward. We're going to have a look to this together. And if you look at this box here, you can see we can expect about $100,000 per year using our strategy. Before we dive in this spreadsheet, we're going to have a look to one of FTMO section that is talking about paying millions, and of course the financial health of FTMO. FTMO is a company that has been incorporated back in 2015, so they are now in the game since about 10 years. They are very solid in the industry. As you can read on this article that was published back in July this year, you can read prop trading giant FTMO's 2023 turnover. It's $213 million. So that's the highest number we've seen in this industry for a prop firm, with EBITDA, so earnings before interest, tax, depreciation, and amortizations of the company, also reached nearly 100 million. So they are making real profits out of this, and they are far away to go bankrupt, like we've seen other companies going bankrupt those last month, this last year, if I can say, in 2024, especially at the end of first semester back in May, we've seen several issues with prop firms. That's why we want to stick with the top leader in the industry, which is FTMO. So I'm not going to dive in all the details of this article, but the main point to understand is about the more than 200 million revenues, and at the end, more than 100 million EBITDA in their pocket. Here, FTMO is sharing kind of the payouts they have already done. You can see they've done about 1 million payout in the United States. That was before when they allowed US traders. Fortunately, we allow US traders to join FTMO thanks to our special solutions. So if you're interested, do not hesitate to get in touch with me with link in the description. We can offer you, if you are in the US FTMO account, we just have to bypass kind of FTMO rules, and it's pretty straightforward and not very difficult. At the end, it's even easier. It's a full hands-off process where you don't have to do anything and you still have the security of having your account. You can read 75 million payout in 2023. So that's what you can see on this chart. They've gone from 3.4 million in 2020 to 75 million payout in 2023, which shows the growth of the company is pretty impressive. And we can expect 2024 to be close to the 100 million payout. So we're gonna know this maybe beginning of next year when we'll be ending the year. It's almost the end of 2024 now. So that's the main two things I wanted to show you before diving in these spreadsheets. So we're gonna have a look to it together. I'm gonna work you through step by step, and you will be able to understand how we can generate $100,000 per year with this strategy, which is about 8,300 per month. So how does it work? It's pretty straightforward. on this spreadsheet, you can see on the top, we are looking at FTMO account. The account size is 200,000. We will have 200,000 accounts. So total portfolio is 1 million. The split from the prop firm is 80%, meaning that all the profits generated on your funded account, you'll receive 80% of that from FTMO. So that's the first details we need to know. And we can see here on the right, we have the different costs. So a challenge cost on FTMO is roughly 1,200, a bit less at the moment with the dollar. That is about 1150 at the moment. We're going to keep those numbers just for the example, but we could take 1150 definitely. That would change a bit the numbers, but not that much. So that would be the cost of a challenge on FTMO. If you decide to go on this process on ftmo.com, you see the challenge fee for a 200K account is roughly 1,200. Then we need to invest hedging collateral. So just let me remind you, if you're not familiar with hedging, I've already explained that, but it's always better to repeat it. So hedging is like a balance where you will have two accounts with opposite trades. If one account goes one way, the other account goes the other. And if it's the contrary, we see the same dynamics in different directions. So it's like a safety net that you are putting under your prop firm account so you don't lose money at the end. Technically, it's a higher investment, but you are safe, offsetting the financial risk thanks to the hedging collateral. So that's very powerful. You should see that like an insurance, basically paying this at the beginning, but if there's any issue with the account, you are safe and insured. What does it mean with the numbers? Let's look at it. Here on the spreadsheet, you can see if prop account fails, if prop account wins. So those are the two scenarios. Let's say we start a 200K account on FTMO. The phase one target will be 10%. That's the D10 box you can see here, which means $20,000. We need to reach this target to pass to phase two. If we pass to phase two, we'll have to do 5%. And if we pass phase two, we'll be funded. And at this stage, we'll receive first payout. So how this spreadsheet work? I've already told you the two scenarios. Here you have the steps, the targets I've just mentioned, the hedging collateral I've talked about, which is the second account. We'll have a broker account on one side and the prop firm account on the other, with the hedging collateral being on the broker account. If prop account wins, broker account lose. If prop account lose, then broker account wins. That's what you can see on the two scenarios here. Let's take, for example, phase one. So let me hide those lines so we don't disturb. We can focus on the first line. You can see here, we need to reach 10% profit to pass phase one. In the case we win, we will lose our collateral. So we will lose those 1,900 that we've put on the broker accounts. We will burn them. That's kind of the insurance. Since we didn't breach the account, we paid the insurance, but we didn't use it. Does it mean we made a bad move? I don't think so. Is it a bad move if you take your car all your life without having any accident, without having any crash or accidents, and you did pay your insurance? I don't think you did a bad move paying insurance. You know what I mean? So you protected yourself. The best way would be to always win, but as it is in everything, we will lose sometimes, and at those times we have a safety net. So if prop account wins, we lose 1,900. If prop account fails, let's say we fail phase one, we reach the minimum 10%, which is the maximum loss allowed on FTMO, about $20,000. If we go to $180,000 balance, which is 20,000, which is 200,000 minus 20,000, we would breach the account. In that case, we will generate about 1,300, 1,200 on the broker account. So our balance on the broker account will go from 1,900 to 3,200. Basically, 1,900 plus 1,200 profits equals plus 1,300 equals 3,200. With those profits, we will withdraw the challenge cost, so 1,200, send it back to you so you can buy back another challenge. And that's how the process auto-finances itself and how we can continue the process without asking you to reinvest at any point of the process. So that's how it works. We'll continue trying again until we pass. And after we pass, so we'll move to phase 2. And phase 2, as we've seen, it's quite the same thing. So now I have explained the phase 1 principles. It's the same thing for every phase. As you can see here, we need about 2,000 collateral. If we win, we will lose this collateral, but we'll be funded. If we lose, we'll make $3,000 this time. Why is it way more than phase 1? Because we need to refinance the hedging collateral we lost in phase 1 if we fail at this point. And the amount we made here will allow us to start back the process. As you can see here, we have on the broker account about 5,100, and the process to start back is about 5,200. So that's counting a 15% spread and commission cost. So it's very close to it. And like I've said, we are more to 1150 at the moment. So you would be $50 from the total investment cost. Basically, we are putting the rest out of our pocket. You don't even have to put the $50 more. So that's how it works. Now, let's say we are funded. At this stage, we will just make a little profits, which is 0.5%. The target is only $100. So we can request challenge refund. As you might know, the challenge fee is refundable. So we'll use the challenge refund as funded to collateral. At this stage, you can see we have about 1,300, 1,200 hedging collateral that is coming from this box in column N, which is the FTMO payout. I didn't talk about this column yet because we don't receive payout in phase 1 and phase 2. But here, when we are funded, that's the main column you want to look at. It's the payouts we will receive from FTMO. These payouts will have to deduct next hedging cost. Then we split the profits, the left profits by 2 between you and the company XO Capital. In that case, you will receive the challenge refund, about $1,230 in this example, plus the 80% of these $100 funded 1 target that we reached, and it will allow us to move to funded 2. Funded 2, we have a higher targets because we have more collateral. So we now target 2%, about 2.1%. The profits is 3,400. This time we'll also have to reinvest everything in next hedging cost. So that's funded 3 that becomes very interesting when we have about 3,400 hedging collateral. In that case, if prop account fails, you make about 1,600 net in your pocket. And if prop account wins, you make about 1,200 net in your pocket with the chance of moving to funded 4. That's the good thing about this process. As you might understand now, even if we fail, we can continue or even make some profits if we fail by funded 3, 4, or 5. If you fail at funded 4, for example, you would already have received the funded 3 payout of 1,200 plus this amount, 2,400. So it's about, as you can see on bottom right here, 3,500 profits net in your pocket with the process restarting itself, auto-financing itself, I can say, without any reinvestment on your side. So that's the good thing about this strategy, is that you don't have to add some some fuel on the, you don't have to feed the fire, if I can say. It auto finances itself. So that's how you can generate $10,000 every 6 months with a 200K account. So you can read here 2 to 4 weeks per phase, and we have 7 steps. So if we say 3 weeks on average, that would be 21 weeks. So this twice, that would be 42 weeks. Knowing we have about 52 weeks in the year, it gives us some margin. And our average is a bit below 3 weeks for each phases. That's what you need to know. Roughly the total payouts per semester we'll receive is about $20,000, and we'll divide this 50-50 with a net profit for you, the investor, of $10,000 and a net profit for Exo Capital of $10,000 as well. During the year, we'll be able to do this twice, so you now understand that's where this number is coming from. It's twice this amount, so it's twice this process here, as you can read here on line 24, the twice this process per year scenario. Thanks to this, now you can do the math. If a 200K account yields $20,000 expected annual net return, then you 5 times this number and you get to $100,000 expected annual net return with a portfolio size of 1 million. So 200K times 5 equals 1 million, 20K times 5 equals 100 million. The thing is, as you might have understood, we need more working capital for 1 million portfolio than a 200K account. We've seen together the cost of hedging, or the hedging collateral, if I should say. It's not a cost, it's more an investment collateral. $4,000 for 200K. So for 1 million, you would need $20,000 collateral. Adding the challenge fees, it leads you to about $26,000 required working capital to start a 1 million. So that's quite a big amount. That's why you don't have to start up directly upfront with 1 million. You could start with, let's say, 400K, and after 6 months, so you receive 20,000, you'll have 200K accounts. So you receive twice $10,000 from both those accounts at the end of the 6 month. So you'll be able at this time, with the $20,000 profits you receive, to buy back another 3 accounts that will cost about 15,000 to reach the 1 million mark, and keep 5,000 in your pocket to reduce a bit your risk. So you don't have to start directly with 1 million because the cost is quite high. I agree with that. You can start with lower portfolio size and compound your profits. Let's say, like I mentioned, you start with 400K. After 6 months, you receive 20K. You buy 3 new 200K accounts for 15,000. So you keep 5,000 in your pocket, and you now have a 1 million portfolio that 6 months after your investment should yield 50,000. So in this scenario, you compound and you start with 400K. After 12 months of the beginning, you receive about $50,000, being 6 months of 1 million portfolio. Knowing you took out 5,000 after the 6 months and reinvested 15,000 of the $20,000 profits you made from the 400K portfolio after the 6 months. So that's how we can generate $100,000 per year with this hedging strategy on prop firms. If you're interested to talk with me about a 1 million blueprint, a 400K blueprint, a 200K blueprint, you want to cover the spreadsheet we've seen together, maybe there are some points you didn't fully understand, I'd be glad to chat with you. Feel free to book a call with me with the link in the description. You can also check directly our website, exocapital.com, exocapital with a K.com. Other than that, I wish you an amazing week, and we should talk on the next video.